If the stock market is an ocean, most of your retirement money is probably riding on a cargo ship. It's safe, it carries a lot of weight, but it takes miles to turn around. Right now, though, everyone on those ships is staring over the railing at a speedboat. Over the last 6 to 12 months, financial headlines have been dominated by a handful of newer, lesser-known small-cap mutual funds generating massive returns, some crossing 24 or 25%. That number stings like you hold one of the established, household-name small-cap funds. If you've been checking your portfolio lately, you've likely seen your returns crawling in the low single digits. This chart shows exactly how wide that gap has become over the last year. TrustMF is sitting at roughly 24%. Motilal Oswal is at 15%. But look further down. Quant is at 8.9%, Bandhan is at 5.2%, and industry giant Nippon India is sitting at just 3.5%. TrustMF delivered nearly 7 times the return of Nippon. But to understand how that happened, you have to look at the hidden variable driving this chart, the sheer amount of money they have to manage. TrustMF is operating with an asset under management, or AUM, of just under 2,500 crore rupees. The giants they are beating are managing tens of thousands of crores. Seeing a 24% return while you're holding a 3% return triggers an immediate reaction. It makes you want to sell, pay the exit loads, eat the capital gains taxes, and dump your cash into whatever is moving fastest. Before you do that, you have to answer a mechanical question. Did the team at TrustMF discover a brilliant new way to pick stocks, or are they simply playing a structural game that the big funds are mathematically forbidden from playing? Buying into a high-performing fund without understanding how fund size dictates its strategy is a highly effective way to buy in right at the absolute peak of a market hype cycle. TrustMF's underlying stock-picking philosophy relies on an acronym called GARV, Growth at Reasonable Valuations. Usually, a mutual fund evaluates a stock's price by looking at the company's projected earnings for the next 2 or 3 years. If the math makes sense in that short window, they buy. TrustMF breaks from the pack using terminal value. Instead of projecting just 2 years, they anchor 70% of a valuation to earnings 5 to 8 years out. This forces them to aggressively buy highly scalable businesses, like non-banking financials and healthcare. Because they are pricing in a decade of growth, these stocks look quite expensive by traditional short-term metrics. You are paying a premium today for a business you expect to dominate tomorrow. That intense focus on high-growth assets is exactly why the fund skyrocketed recently, but it also exposes a severe vulnerability. The moment the broader market gets nervous and investors rotate their money back into safer, defensive, or value-oriented stocks, a portfolio built entirely on terminal value will systematically underperform. Knowing what they buy is only half the equation. The real driver of their 24% return is how fast they trade it. TrustMF carries an annual portfolio turnover rate of 1.5 to 2 times. The managers cycle through the value of their entire portfolio twice a year. They are constantly reacting, shuffling, and rebalancing the deck every few weeks. They structure the fund to do exactly this. They keep a steady base of about 40 to 50 core stocks, but they surround that core with 10 to 15 highly active satellite positions that they rotate in and out to chase immediate opportunities. This graph tracks how effectively they used those satellites. In April, they took cash reserves and perfectly timed the market bottom to buy equities. In July, they loaded up on IT stocks right before a recovery. By August, they dumped commodities completely, avoiding a sector drag that pulled competitors down. But agility isn't free. Swapping out stocks at a 200% turnover rate generates massive internal transaction costs and trading fees. That friction eats directly into your net returns. It also requires the fund manager to flawlessly predict the broader economy over and over again. Statistically, timing macro sector rotations perfectly year after year is impossible. They hit a hot streak, but relying on a manager to never guess wrong is a highly dangerous indicator for future returns. Which brings us to the obvious question. If using a fast-moving satellite strategy works so well, why don't the massive funds like Nippon or SBI just copy it? They can't. They are trapped by the financial law of AUM gravity. The larger a fund grows, the more restricted its movements become. This quadrant chart maps how size kills speed. You have fund size vertically and trading speed horizontally. Industry darlings like Nippon and SBI are tightly clustered in the high AUM, low turnover zone. Down here, operating without the constraints of scale, is TrustMF. The giants are stuck because of liquidity. If a massive fund decides to sell out of a tiny microcap stock, they can't just hit sell. If they try to unload 500 crore rupees of an illiquid company in a single afternoon, their own massive sell order will crash the stock price before they can even get out. They have to move slowly, over months. And that creates an ironic doom loop for TrustMF. Because they posted a 24% return, financial media talks about them. Retail investors see the headlines, and a flood of new capital pours into the fund. As TrustMF's asset base balloons from a few thousand crore to 10 or 20,000, AUM gravity will take hold. They will lose the ability to rapidly rotate those satellite stocks. The exact mechanical advantage that gave them 24% will disappear, mathematically forcing their future returns back down to match the industry giants. So, knowing exactly how this engine works, what should you actually do with your portfolio today? This flowchart breaks down the decision based on your specific investor profile. If you are the yield chaser, meaning you saw the 24% headline and want to buy in for a quick gain, the answer is a hard avoid. You are buying into a high turnover strategy right at the top of its current macro cycle. If their market timing falters, or if the market rotates away from high-growth terminal value stocks, you are highly exposed to a severe downward correction. If you are the portfolio optimizer, meaning you currently hold a giant fund that is underperforming and you want to swap, your move is to hold your current position and put this on a watch list. Paying 15% in short-term capital gains and an exit load just to switch funds means you're jumping into TrustMF exactly as AUM gravity is preparing to paralyze their strategy. The math on the swap simply doesn't justify the cost. Finally, if you are a long-term allocator looking to build a brand new small-cap position from scratch with fresh capital, you can start a cautious SIP, but you have to commit to a 5-year horizon. You are buying into a solid GARV framework, but you must be prepared to sit through the inevitable periods where their growth methodology temporarily falls out of favor with the market. Don't make decisions based purely on recent speed. In the small cap market, yesterday's agility is almost always destroyed by the massive scale it creates tomorrow.